Venture capital isn't just about securing funding, it's about building a long-term partnership between investors and founders. When a startup takes on venture capital, the relationship can last anywhere from 5 to 10 years, sometimes even longer. And in that time, the dynamic between founders and investors can shape the trajectory of the company. If expectations aren't aligned from the start, things can quickly go off track. Misalignment can lead to friction, slow decision-making, or even outright conflict, all of which can stall progress and weaken the company's ability to grow. Many founders approach venture capital with one goal in mind: raising money. But the reality is, investors bring much more than capital to the table. They provide strategic oversight, governance, and guidance, along with expectations for growth, accountability, and, eventually, an exit. At the same time, investors must recognize that founders need space to operate, innovate, and execute their vision without excessive interference. So how do both sides ensure they are on the same page from day one? It starts with defining the investor's role. One of the first conversations between a founder and an investor should clarify what kind of involvement the investor will have after the deal is closed. Will they take a seat on the board, actively shaping the company's strategy? Or will they play a more informal advisory role, stepping in only when needed? How often will they expect updates, check-ins, and strategic discussions? Will they be involved in hiring key executives, forming partnerships, or making major business decisions? And what level of financial oversight will they require? Some investors prefer to take an active role, offering hands-on support in scaling the company, while others take a more passive approach, stepping back until critical moments arise. Understanding the investor's preferred level of engagement from the start helps prevent misunderstandings down the road. Venture capital firms don't just invest for the sake of it, they operate under strict timelines. They raise funds from their own investors, known as LPs, with the expectation of delivering strong returns within a set period, usually 7 to 10 years. That means they typically adopt an aggressive growth mindset, expecting their portfolio companies to scale rapidly. Before investing, VCs need to have an open discussion with founders about what that growth looks like. What are the revenue targets? How fast does the company need to expand its user base or enter new markets? How long should the startup operate before raising the next round of funding? And when that time comes, will the investor help secure follow-on funding? What milestones need to be hit before that happens? And then there's the bigger question, the exit strategy. Is the goal to go public, to sell the company, or to build a long-term independent business? Venture capital is about generating returns, and investors will have their own expectations about how and when that happens. If those expectations don't align with the founder's vision, tensions can build. The pressure to scale quickly, to expand aggressively, or to raise more capital at a faster pace can create friction if both parties aren't on the same page. One of the biggest sources of frustration between founders and investors is poor communication. Investors don't want to micromanage, but they also don't want to be left in the dark. Establishing clear communication expectations from the beginning can prevent a lot of unnecessary tension. How often will updates be provided? Monthly? Quarterly? Investors typically expect structured reports that cover key metrics, growth progress, and any major challenges the company is facing. Board meetings are another crucial touchpoint. These aren't just formalities. They're where strategic decisions are discussed and debated. And then there's crisis communication. What happens when things go wrong? Because in startups, challenges are inevitable. Whether it's a missed revenue target, a failed product launch, or an unexpected market shift, investors need to be informed early. The worst thing a founder can do is delay sharing bad news, as it limits the ability to respond effectively. As a VC, your role isn't just to track performance, it's to help solve problems. Whether that means leveraging your network to bring in key hires, securing bridge financing, or providing strategic guidance, early and open communication ensures you can step in with the right support before challenges escalate. A startup's leadership should ultimately be in the hands of the founders. But once venture capital is involved, investors have a stake in the company's future, and they will expect some level of influence. The key is finding the right balance. Investors typically want to be involved in big picture strategic decisions, things like ensuring the company is on a scalable growth path, hiring key executives, advising on fundraising strategy, and weighing in on exit opportunities. But what they shouldn't be doing is interfering in day-to-day operations. Founders need the freedom to make tactical decisions and execute their vision without excessive oversight. That's why it's critical to establish boundaries early. Which decisions require investor approval? How much say do investors have over hiring and long-term strategy? And what happens if founders and investors disagree on a major decision? A well-balanced investor-founder relationship allows investors to provide meaningful input while still respecting the founder's autonomy. Startups don't grow in a straight line. There will be setbacks. Revenue growth might slow, product launches might fail, or the company might need to pivot entirely. How founders and investors handle these tough moments often defines the strength of their partnership. So, what happens when things don't go as planned? Investors expect challenges, but they also expect founders to be proactive in addressing them. If revenue starts to stall, what's the plan to course correct? If a major product fails, how will the team adapt? If the business model needs to shift, how will the company navigate that transition? The best investor-founder relationships are built on trust, where both sides are willing to have honest, sometimes difficult conversations. Investors want to see founders take responsibility, make data-driven decisions, and approach problems with a clear plan, not ignore warning signs or make excuses. At the same time, founders need investors who support them through difficult periods, not just when everything is going well. The best investors understand that setbacks are part of the journey, and they remain engaged, offering strategic guidance rather than just applying pressure for short-term results. Raising venture capital isn't just about securing funding. It's about entering a long-term relationship with investors who will play a significant role in shaping the company's trajectory. To make that partnership work, both sides need to be aligned from the start. Defining the investor's role, setting clear growth expectations, and establishing a structured communication process all lay the foundation for a successful collaboration. At the same time, maintaining a balance between founder autonomy and investor influence is crucial to keeping the relationship productive rather than adversarial. And when challenges arise, and they will, transparency, problem-solving, and trust will determine whether the company emerges stronger or struggles under the weight of misalignment. At the end of the day, the right investor-founder partnership isn't just about capital, it's about working together to turn a vision into reality. And when that partnership is built on clarity, trust, and shared goals, it has the power to take a startup from an early-stage idea to an industry-changing company.